Welcome. I'm Nathaniel Evans. On behalf of Utah Valley University's Plan Giving Department, we're thrilled to host this online workshop focused on ideas for investing in an uncertain future. As Utah's largest public university, Utah Valley University is committed to serving the community through accessible education and student success. We appreciate the community members and alumni who serve our students. We hope this webinar will help inform and inspire you as you plan your investment strategy. This seminar is part of a series focused on important financial topics presented by seasoned professionals in exit planning, estate planning, taxation, finance, and investment management. Many of our presenters serve on Utah Valley University's Gift Planning Advancement Board that encourages and enhances engagement and philanthropy at our university. During this webinar, your video and audio features are disabled to create a focused learning environment. At this time, I'm honored to introduce our esteemed presenter, Carrie Wasden, a seasoned investor who will provide you with valuable insights.
Good morning. Today we are recording a webinar based upon a presentation that was delivered on the 21st of May 2025 to a UVU Economics Symposium. I'm Carrie Wasden, and I'm a UVU professional in residence as well as a senior partner at Keeler Thomas. To set the stage for this presentation, I want to just give a disclaimer. Firstly, this is more of a discussion than a presentation, so my mode of presentation will be pretty casual. I'm going to use some slides, I'm going to tell some stories, but I'm going to generally talk in a conversational manner. To do that, and to start out with, I'd like to first talk about how markets behave. In the short run, as stated by Warren Buffett, markets are voting mechanisms. In the long run, they're weighing mechanisms. So obviously in the short run, they can be pretty volatile, going up and down based upon what information comes out and how to vote. For example, today on the 27th of May, we have a fairly significant upward move in equity markets based upon news that the Europeans are coming to the table with the Americans to discuss tariffs. That has caused the markets to vote positively and expect things to be better in the future. Now, we don't have any data. There's no data that shows exactly what's going to happen. That's why in the short run, things are voting. In the longer run, we would look to corporate profits, economic growth, international trade, actual numbers to weigh what has happened. So in the presentation today, I'm going to start out by talking about some historical perspectives on where the market has been as a means of setting a stage for where we're going to go in the future. In the past, and when I say in the past, in 2019, before the pandemic, everything was just right. We called this the Goldilocks market. The reason? Economic growth was slow but steady. Inflation and interest rates were both accommodative. This has been lasting for a very long time. In fact, it was the largest economic expansion in modern history. Also, the largest equity bull market in history. And then came 2020. Our memories are still pretty full of experiences with the pandemic. It broke upon us in January of 2020 and caused us to think of things like mobile morgues in New York City, which this picture depicts. The uncertainty of the pandemic environment caused equity markets to plummet. But very quickly, in the face of government stimulus and support, markets began to take off. Over the course of 2021, we had fairly significant increases in stimulus from the government to the tune of almost $13 trillion. Since a lot of us were at home, working from our couches or dinner tables or desks, we had a lot of extra time on our hands. A lot of people became short-term traders, using the stimulus money to goose market returns. This is the graph, the gold one, of cumulative return from the beginning of 2019 for companies in the S&P 500 that lose money. Notice the extreme positive gains that were yielded during the pandemic period. The blue line much more conservative by return, is the S&P 500. The increase in stimulus money, the increase in number of investors investing that stimulus money or trading it, caused an increase in what we call the animal spirits and increased the risk profile and appetite of investors across the board. This is a graph of GameStop, a stock that was almost bankrupt before the pandemic, but in the face of new investors who are very, very anxious to put it to the man, the new investors began to start to invest in these shares, which caused the prices to skyrocket. Something similar happened with AMC, the stock price for movie theaters. Notice it drove significant gains on the back of additional investors coming from stimulus money, and then has come all the way back down again. Interestingly enough, today alone, the AMC stock was 23% higher. What drove this move? Voting. It moved on the back of investors who thought the increased ticket sales of movies like Lilo and Stitch and Mission Impossible would revive the fortunes of movie theaters in general. This is the meme index, very, very characteristic of this period, where free money, found money, stimulus money entered into companies that really had no foreseeable long-term future in search of quick money returns. And then we get into the period that is known as the Magnificent Seven. This is 2023 and 2024. The Magnificent Seven were basically 7 stocks in the S&P 500. Here you see the percentage of the S&P 500's value that has been driven by these stocks. We went from 16% in January 2019 to almost 33% today. That overweightedness is both a positive and a negative. Positive because it drove the whole market, because the S&P 500 is a market value weighted index, but negative because now the whole market's return are dependent upon 7 stocks. The graph down below on the left-hand side is a cumulative return graph of the Magnificent Seven in gold from January 2019 to present, and the S&P 500 in blue. Notice the gains are disproportionately favoring the Magnificent Seven. Here we have the Magnificent Seven actually broken out. From January 3rd, 2003, we have an incredible return from the AI semiconductor producing company NVIDIA, up 838.7%. And you see the other Mag 7s are all in blue, and then the indexes in gold. You can see that the increase in any of the indexes really owed their gains to the Magnificent Seven stocks directly. And so we come to where we are today. These are year-to-date returns. First, we'll look at countries. Spain, large gain of 24.2%. Keep in mind, this is as of the first 5 months of the year. A stunning return. Germany at 20.7%. The euro in general up 11.4%. The United States is bringing down the bottom. The Dow is flat. The S&P 500 is slight gain. And the NASDAQ 100, which is the largest 100 technology companies, is actually negative on the year. So what's going on here? What we're seeing is a fairly significant move out of the United States. Some of that has to do with the uncertainty of the economic environment given the tariff gains. Some of it has to do with just a preference for undervalued stocks in Spain and Germany and other European countries. The United States is valued at 22.8 times. The rest of the world, in Europe in particular, is still valued at 12 times. So the rest of the world is 1/2 of the valuation of the U.S. market. That's a significant driver for stocks and stocks investors moving abroad. Looking at year-to-date returns, gold is by far the winner. Bitcoin isn't far behind, but the rest of them are very modest gains, with commodities, high-yield bonds, government bonds, corporate bonds, and then stocks rounding out the bottom, with the exception of crude, which is the poorest performer. Looking at equity instruments, The world index, largely driven by Europe, has posted a significant gain. The NASDAQ 100, which is our technology index, is still strong as well. The money losers, the riskiest ones, have the worst gains, down minus 7.1%. Looking at sector gains, it's an odd combination. Usually, a broad narrative takes over the marketplace. And in that broad narrative, we have a sense of things are going to grow economically or things are going to stagnate, and different sectors would perform differently in that environment. But this one's a bit schizophrenic. Industrials, which are cyclical, and utilities, which generally are counter-cyclical, both lead the chart in best returns. So what we're not seeing is a general sectoral trend. And that's where we stand today. Now, I'd like to go through a few keys to think about. And what I'd like to lead you to is potentially subscribing to our publication called The Weekender, which highlights our investment strategies and what we are doing as a firm and as a group to take advantage of the market moves. I want to give you a bit of a headlamp as we get into these. It's going to sound really negative. And it's not that we're really negative, it's that the markets are priced for perfection. And we don't believe that perfection is going to be what is delivered. We believe that as data starts to emerge from the third and fourth quarters of this year, that the data is going to reset expectations. And the markets are going to move away from voting and move towards weighing. And so we're getting our portfolios prepared to do that. So I'm going to talk about a few points to consider. I'll do them one by one and then give you an invitation towards the end. Consumer. Approximately 70% of U.S. economic growth or production comes from consumer spending. Consumers continue to spend. Many have believed that this means the consumer is resilient and can continue to be able to absorb whatever economic environment is presented to them. Some think that the consumer is just being a bit foolhardy. We believe there's probably a combination of both. There are certainly signs of a slowdown in consumption and in corporate earnings. Corporations around the United States are releasing earnings for the first quarter, saying it looks like the first quarter was remarkably strong. But at the same point, they're withdrawing guidance for the second quarter and the rest of the year because of the lack of visibility given the high tariff environment. We believe this uncertainty is going to increase into the second and third quarters. At this point, we look at the consumer and are concerned. Credit, maxed out. Savings are spent. Stimulus is gone. Signs of stress are increasing. And now, student loans are going to start being required to be repaid. All of this point to a consumer that is softer and softer. In measuring the health of the consumer, we can look at consumer sentiment. We can also look at consumer confidence. Consumer sentiment is heavily reflected by the environment of the tariffs, where so much uncertainty causes them to be unsure. Consumer sentiment has dropped to one of the lowest levels on record. However, in data just released, consumer confidence showed an unexpected uptick. Part of that has come from expectations that some of these tariff agreements may actually be struck, and that will have a positive impact on the consumer going forward. The reality is it's tough to get too negative on the consumer unless the labor market gets broken. This is a graph of job openings for every unemployed person. We're just about at 1, which suggests that the labor market isn't broken, and if you lose your job, there's another one waiting there to be had. This is an unexpected environment that came out of the pandemic era. Business formations, the emergence of the side hustle. Business formations continue to be very high and suggest that people are gaining economic benefit by starting something other than their initial job. Consumer income relative to spending, though, is trending to the lowest levels that they have been in a very long time. Consistently, we spend everything we earn. However, we continue to spend more and more of our income than we did in the past, and that's concerning for the consumer. In short, the consumer remains resilient. In other words, they continue to spend in the face of softness that is becoming increasingly more prevalent. Inflation. This is the one-year inflation expectations. It's peaked above 7%. Now, this is what we consider soft data. It's not actually an observed fact. It's a bit of a feeling. Consumers were polled and said, where do you think inflation's going? And this is their response. Now, part of this is due to the tariff world and the constant drumbeat of tariff news, which causes consumers to be wary of where prices are going. And so we'll have to track this and put it up against real data to see where the data comes out. The real data at present shows inflation coming close to the 2% level that the federal government or the Federal Reserve has set. But we're still uncertain as to what the impact of tariffs will be on the future of inflation. Where we are concerned is that companies are overbuilding their inventories. They did that in part to get in front of the tariffs, and now companies have a lot of inventory and a consumer that is increasingly softer. That means to get rid of that inventory, they're going to have to start lowering their prices, and that could be problematic. It will certainly reduce their margins. Interest rates continue to be constrictive, which means they're not accommodative. 10% tariffs are going to cause enough inflation that the Federal Reserve is going to be hesitant to lower their interest rate expectations, and they'll probably keep rates higher than they would otherwise be. Likely, they will only decrease them significantly when the damage to the economy is at least noticeable. Recession. This is the Citi Economic Surprise Index. What it shows is that the economic data that is coming out softer than was projected or expected. We certainly expect an economic slowdown. A recession, we're uncertain. We'll certainly get a recession in earnings. We'll talk about that in a second. What remains to be seen is exactly how far tariffs will push down demand. That is an absolute unknown, and we'll watch the data to see where those things end up shaking out. Corporate profits as a percentage of GDP. This is a long-term graph going back to 1950. And the point of the graph is just to show corporations are increasingly important to the GDP because the profits that they generate are increasingly larger and larger and larger. Retail sales growth, you can see this huge jump following the pandemic. That's a sense of all this found money now being able to find a home in other products and services. That has now come back down and moderated to something close to 5%, which is still wonderfully positive. We would be worried about retail sales growth if it gets down to a negative number. So this is a data point that supports the idea that the consumer, although softening in their expectations, they continue to spend. And by the way, this is not uncommon. It's relatively common for consumption growth in retail sales to continue to be positive until you hit the recession wall, and that brings everything to a halt. This is a graph of stagflation, the blue line, and the gold line, which is the S&P 500. The point being, companies that trade based upon the positives of stagflation did extremely well going into the first part of the year. They've now come back down, and the S&P 500 as of today is actually beating the stagflation index. And so there's been a complete alteration, a change, an about face of the narrative driving the market away from stagflation and now towards growth. This is earnings per share for the S&P 500. We worry about this one a lot. Earnings are impacted by demand. If we have strong demand for products and services, earnings will go up. It's also impacted by margins. The more inventory we generate and the more inventory we are storing, waiting for especially the Christmas or holiday season spending, creates an environment where to get rid of that inventory, prices have to be dropped. Lower prices feed into lower margins. Lower margins drop profits. Profits are the primary fundamental driver of stock prices. So if we're expecting lower earnings estimates going forward, we should expect, all things being equal, lower stock prices. But as you can see from this graph, earnings estimates are coming down, but stock prices are not. Stock prices are rising. Those two things eventually will have to be reconciled. And so we would look towards that as a alteration or a change in market sentiment, where once we have to continue moving down earnings expectations, we're going to have a capitulation in the market. Valuation. Most historical evidence suggests that markets don't retrench based upon valuation alone. Certainly it's important, but it's a bit of a waypoint to measure where we are in a certain trend. And right now, U.S. markets, as measured by the S&P 500, are trading at 22.8 times earnings. That is extremely high by comparison. The average is 17.8, which is represented by the red line, and we're well above average. If we get continued moves lower in expected earnings, that makes the valuation number rise. The point is, markets are priced for perfection, and we do not believe perfection will be delivered. There must be some sort of reconciliation between those two things in the future. Geopolitics. In general, stock markets tend to be resilient relative to geopolitical trends. But I want to give a short history lesson. In 1989, as a bit of a throwback from a clerical error, the Berlin Wall fell and the end of the Cold War began. This was an absolutely revolutionary event. It spurred a number of interesting institutional changes. In particular, global and multinational groups started to work together. We had a bit of a kumbaya moment, where books like this one, The End of History and the Last Man by Francis Fukuyama, which was published in 1992, was released, and it suggested that we are going to find ourselves in a position where all countries are working towards a similar end, that is, liberal democracies based largely on market principles. And it seemed to be working. At least it seemed to be working for a while. But over the next generation, there seemed to be some fissures in that kumbaya moment, and we found ourselves in a position where some countries just got exhausted and said, enough of this. Brexit, where the UK left the European Union, was one of those examples. And following Brexit, a number of other countries started to have similar feelings, and we experienced a rise of nationalization where countries began to feel like it's better for them to not focus on the good of the world, but to focus on the good of their own country. This sole-sourced focus has been causing an incredible change in the global perspective on what we owe to one another, and has been settling down to this view of what we owe is to ourselves. This fundamental change is significant and is very likely to lead to substantial, pronounced military conflict. Look at what's happening right now with Russia and Ukraine, a lower standard of living, and considerable asset price uncertainty. Consider this as an example. This is a young white woman in Japan who is a new recent owner of a Japanese rice field because Japan does not have enough children to raise farmers to take them over. So you can now buy a farm in Japan for $100 as long as you're young enough and promise to stay there for a generation and raise rice to feed the population of Japan. This kind of environment creates an incredible structural dilemma. And the structural dilemma is, we have never been in a position, other than short periods of pandemic and epidemic, we've never been in a position where global populations were shrinking. We have always been able to get our way out of problems by relying upon a bigger and bigger pie. Now the pie isn't increasing, in fact, it's decreasing. And we're all going to be fighting over how big of a piece of a pie we get. Those type of fights always lead to negative, disastrous outcomes. And that is one of the structural, and perhaps the biggest structural issue we're ever going to have to deal with, is the end of growth. Now, many expect that artificial intelligence will step in and save the day, and to some extent that certainly may happen. But it hasn't yet, and it's remarkably unclear as to how that will happen. Now, let me address my disclaimer. At the beginning of this, I mentioned that this kind of stuff's going to sound sort of negative, and it is. But the reason for the negativity is that markets are priced for perfection, and these are things that are very likely to upset the perfection cart. And it doesn't have to be all of them. It could just be a couple of them. We are certainly likely to get at least half of them. And that alone is enough to reset expectations. We are preparing right now for all clients to take advantage of that reset. We're fully invested, but we are moving increasingly more and more towards an environment where setting our clients up for safety and security, moving into places where there is growth in unit sales, growth in margin, and pricing power, are going to be critical to positioning our clients in equities and fixed income securities that will benefit them over the next few years. We don't discount the gains and the continued gains in things like artificial intelligence. That is a structural element that is going to continue, and we continue to be invested in that completely. But as a broad market environment, we believe clients should be expecting, predicting, preparing for a degree of slowdown. Now, we encourage you to subscribe if you would like to for our Weekender. It's free. Just fill out a form on the Keeler Thomas website, and you can get a free email of that publication. We invite you to schedule a meeting if you'd like to chat in more detail. We have enjoyed this opportunity to get together, and hope this presentation was helpful. Thank you.